My name is Jake. Welcome to the channel. I want to share with you something really cool that I experienced this week. So I was looking through the activity in my portfolio. I was looking at the dividend income that I was receiving, and I got two payments from two covered call ETFs, one from JP Morgan's JEPI and JEPQ. These are two covered call ETFs that I invest in. And I was looking at the distribution income that I got from these two ETFs, and I was doing the math and I was like, wait a second, this covers my entire mortgage, property tax, everything that I need to pay on a monthly basis to live in my home. And I started thinking to myself, wait a second, this will pay for my mortgage for the rest of my life, for the rest of the terms of the mortgage, and for the property tax forever. Now, obviously, I can't predict the future. I don't have a crystal ball, but if all things stay constant, which is never a guarantee, this will pay for my mortgage going forward. And that if I were to lose my job, I'm not going to have to go live on the streets. I'm going to have income coming in passively every single month and that are going to pay for my expenses. This was such a cool feeling. And it was just one of those things that, I've been working towards this for so many years, and to finally see it and make that connection, that light bulb connection, it was one of the coolest feelings. So why is this so cool? The reason why this is so powerful and so important is really when you think about it, my wife and I, we're looking to reach financial independence and retire early, completely off of our dividend portfolios. We're not there yet. We have a couple more years before we need to get there, or before we're there. Inflation's kind of a thing now. And so we need a little bit more income than we originally had thought. So our timeline has shifted back a little bit. But the reason why this is so cool is it really comes down to the power of small wins, right? When you think about it, you have this big goal in mind. I want to retire early. I want to have my portfolio pay for my living expenses. That's a pretty big deal. Like, it's a pretty big initiative that's not going to happen overnight. And, in many cases, this is, thinking decades into the future for many of us. Many of you that are following the channel. My wife and I, we've been on this path for, I want to say 5 or 6 years, give or take. But this has been a long process. And, I've always kind of looked out into the future and kind of thought about that big ultimate destination, the goal. But the reason why this is such a big deal is it's a small win. I can translate the dividend income into an actual real life expense that my wife and I have, that we have to pay every month, and that is fully covered by our passive income from our portfolio. And what it ultimately comes down to is the power of small wins. So if you think about it, if you're just focusing on the destination, it can get a little bit depressing, right? If you've ever gone through the process of trying to get into shape, lose weight, right? Maybe you're 20 or 30 pounds overweight, or heavier than you would like to be. You're not going to just lose all that weight tomorrow by going to the gym once or twice, right? It's a process, right? You're not going to learn a new language overnight. It's a process. But in order to stay motivated, it's really important to focus on those small wins. And you really have to consciously think about them and not just think about the end destination. So for me, seeing that the dividend income from these two ETFs now fully pays for my mortgage was the coolest small win that I could have ever thought of here this week. I didn't expect this because I didn't really have it on my radar. And when I did the math, I was like, holy crap, this is amazing. And ironically enough, I was talking with my dad last night because I convinced him to buy some JEPI as well. He's like, Jake, I got like $90 and I only have a couple shares. And I was like, yeah, that's JEPI for you. The main thing, the big takeaway from this video is I don't want you to just think, oh, JEPI is great, like these covered call ETFs are great. That's not really the purpose of this video. The real purpose of this video is I want you to think about those small wins in your life and really amplify them and focus on the small wins that are helping you progress towards your ultimate destination, your ultimate goal, whether that be a few years out, decades out. Focus on those small wins that will help motivate you along the way. Because if you don't, it might look a little like this.
Now you kids are probably saying to yourselves, hey, I'm gonna go out and I'm gonna get the world by the tail and wrap it around and pull it down and put it in my pocket. Well, I'm here to tell you that you're probably gonna find out as you go out there that you're not going to amount to jack squat. You're gonna end up eating a steady diet of government cheese and living in a van down by the river.
So because I'm so proud of this, I want to go and I want to show you here in the activity section here. And I just want to briefly, talk about this. For the majority of you, you don't care about my particular situation, if I can pay my mortgage from my dividend investments or not. That doesn't really matter necessarily to you. But I want to share with you kind of some context behind why this is so important, how I view this, and maybe this can help you if you're thinking about, living off a dividend portfolio in the future, and some things that you can kind of look at. So just looking at the dividend income here from JEPI and JEPQ, these two covered call ETFs brought in over $2,400 in distributions. I call them distributions because that's what they are. They're not truly a dividend per se. It's more of a distribution. So don't get confused when I substitute distribution and dividend. Okay. If you're not sure what that is, go and Google distribution versus dividend and you'll get your answer there. But the cool thing here is, my wife and I's mortgage here in Texas and Austin, where we live, is pretty low-ish. I mean, it's all relative. Somebody in the Bay Area might be laughing and that's like chump change. Maybe somebody in, a rural area in the Midwest maybe be like, whoa, that's way, way more than what I pay. The amount of money doesn't matter because all that matters is what's relative to you. For me, for my wife and I, our mortgage is just around $2,400 a month. That's property tax, that's HOA, that's everything out the door that we have to pay to live in our home on a monthly basis. That is now fully covered by our covered call ETFs here in JEPI and JEPQ. Now that's really exciting because we're not fully there. We're not at our destination yet, but this is a massive win for my wife and I. Now we have more invested into these ETFs than, for example, Procter & Gamble or AbbVie or Costco. Another thing that I'm going to talk about here in a minute is, if I invest $100,000 in JEPQ or JEPI, I'm going to get a significantly higher amount of income from these ETFs than I would, for example, with Procter & Gamble. They're just different investments. Okay, and I'm going to talk a little bit later in terms of what that math looks like and how they fit into my portfolio. But I do want to make sure that you understand if you have a long-term time horizon, that being over 5 years, these covered call ETFs are not for you. Even if they're in a Roth IRA, they're not ideal for you because of the way that the compounding nature works of these, in terms of the total return. But if you have less than 5 years before you plan on living off of your dividend portfolio, these two ETFs may be, something that you want to put on your radar. Maybe, I don't know. It depends on you and your own personal risk tolerance. But just looking at how popular these ETFs are, they haven't been around forever. So if you go and you back test them, they've only been around for a couple of years. But if you look back at the Google Trends over the last 2 years for JEPI, it's just gone up and to the right. There's been more and more interest in this ETF. 3 years ago, nobody has ever heard of it because it didn't exist. And now this is really the cool thing that really blew my mind when I saw this week. This is the total fund inflows here in 2022. Take a look at this. Here on the left are the top 10 ETFs with the highest net inflows. This means money going into them. Now, the top one obviously is going to be your S&P 500. This is like always the case. You got from Vanguard, you got from iShares, and you got the total US stock market. This is not surprising for a lot of you. SCHD in the top 10. This has not happened. I was checking the previous years. This is the first time that I've noticed that SCHD is in the top 10 in fund inflows. But this is cool. Get this. JEPI, it's the 7th largest ETF in terms of net inflows, money flowing into them here this year. But yeah, I just thought that was pretty interesting to see SCHD and JEPI here in the top 10 of inflows here for 2022. So now I want to take a second and I want to share with you how the math works out here when it comes to what we're talking about. So I mentioned that I need $2,400 per month, every month in dividend income to pay for my mortgage. Okay. So you can do a similar exercise, whether it be with your rent, whether it be with your car loan, whether it be funding a yearly travel expense, whatever the expense is, you can kind of think about it. But it's kind of a cool brain exercise to think about, okay, well, how much do I need to pay for my utilities every month? How much do I need to pay for my phone bill, my Netflix, my annual travels to, the Caribbean? It doesn't matter, but the exercise is kind of cool to think about, okay, well, what investment type is the right for me so that I can reach that goal? Because, at the end of the day, what it all matters is your time horizon. When you plan on living off of your portfolio, because investing into Costco or Apple compared to these covered call ETFs or Coca Cola looks vastly different when looking at how much dividend income you need today versus in the future, maybe 5 or 10 years out. And that's all when it comes down to, dividend growth rates. And that's why I talk about time horizon so much on my channel. All of the charts and all of the data that I use in my video is from Seeking Alpha. I've been using them for years. Seeking Alpha actually supports the channel. If you want to sign up to Seeking Alpha Premium, you can get it for $99 instead of $239 by using my link in the description below. So now what I want to do is I want to take a look at the different investments that are out there when it comes to, more traditional dividend investments, like, investing into Costco or Coca Cola or, covered call ETF like JEPI. What kind of capital you're going to need in order to get, a specific amount. I'll just use the example of myself, with the mortgage. You can use whatever example you want. I would encourage you to kind of think about it, subconsciously as I'm walking through this, so you can kind of think about it for yourself. But for me, when I think about our mortgage payment of $2,400 a month, it's going to really vastly differ, investing into an ETF like JEPI versus Costco. And I'm going to walk you through kind of what that looks like. So if you go and you take a look at the dividend payout on an annual basis, and you divide, I'll walk you through this here, kind of my thought process here. So if you got the 625, you divide that by 12, on average, you're getting about 52 cents per month. Now, take this with a big grain of salt. This is not guaranteed because it fluctuates every month, but just on an average, right? So you can see some months it's in the 30s, some months in the 60s, but on average, it's right around that 52 cent mark. So then if you think about it, so then how many shares do I need to get $2,400? So that means I need so in the way that I do that is I do the amount that I need on a monthly basis divided by the income per share, and will give me how many shares I need. So I need 4,615 times 0.52. It will give me $2,400. So in order to pay my mortgage with just JEPI, this is not looking at JEPQ, I'm just looking at JEPI, I need 4,615 shares on average, right? And that's going to fluctuate kind of up and down, right? But just to oversimplify it, that's how that would work with JEPI, okay? And so what does that mean? So 4,615 times 55.55, that means I need about $256,000 invested into JEPI in order to pay my mortgage every month. So that's kind of how that works. Now, if you were to use another simple example of, well, I want to just focus on my, utilities. How much would I need to be able to pay for my utilities? Well, you would use the same exercise where you would say, okay, well, how much do you need a month? What are you investing in? So if I were to invest in a JEPI, this is what the amount that I would need. The next example here that I want to show is with Coca Cola. Now with Coca Cola, this is a little bit different because with Coca Cola, you're getting a dividend on a quarterly basis, not on a monthly basis. Now, to make sure that the example is kind of consistent with the last one, I'm going to do a little bit of math hocus pocus here, and just to make it simple so that it's straightforward and kind of easy to follow. So if we take the exact same process that we did with JEPI, let's say, for example, the annual payout of the dividend is $1.76. So you're going to take 176 divided by 12. That's going to give you just over 14.5 cents per month over 12 months, right? I'm doing this over 12 months. So if you do the 2,400 divided by 0.146, right, that we got here from the annual payout on a monthly basis, it's going to give you 16,438 shares. So in order to get $2,400 on a monthly basis, even though it's, it's paid quarterly, you're going to need 16,438 shares. Now, if you go and you say, okay, well, how much is that going to cost me? It's going to cost you 63.14. It's going to cost you over $1 million at today's share price. So with Coca Cola, in order to pay my mortgage today on a monthly basis, this is spread out over the entire year, I'm going to need over $1 million. What was it with JEPI? With JEPI, I think it was $256,000. So this is I would need 4 times the amount of money in Coca-Cola in order to pay for my mortgage. The reason for this is because of the current starting yield. And this is why time horizon is so important. If my time horizon is today, well, I'm going to need a lot more money invested into Coca-Cola than I would into a cover call ETF like JEPI, for example. Let's use another example using the same methodology with SCHD. This is the Schwab US Dividend Equity ETF here. So if we look at the dividend here, we can see that the dividend yield is just over 3.3%. So if we use the same process here, I know this can be a little bit confusing for a lot of you, but just to make it consistent, once again, SCHD pays a dividend quarterly like Coca-Cola, but if you take the 256 divided it by 12 over 12 months, you're going to get just over 21 cents. So if I take the 2,400 divided by the 0.213 here, you can see that I would need 11,267 shares in SCHD, and in terms of the value, I would need $856,000 invested into SCHD if I wanted to live off of the dividend income today. Okay, so I guess you can kind of see the trend here. Now let's use one last example. This is probably the most extreme example, but just for the sake of it, let's take a look at Costco. Costco has a much lower forward starting dividend yield. And if we take the exact same example, once again, Costco, like Coca-Cola, pays a dividend on a quarterly basis. But if you take the annual dividend divided by 12, that means you're getting 30 cents per month spread out over 12 months. So if you take 2,400 divided by 30 cents, I'm going to need 8,000 shares of Costco to pay for my mortgage today. How much? Oh my gosh, this is going to hurt my brain. At the current share price with 8,000 shares, I'm going to need $3.9 million. Now, do you understand why I'm investing in JEPI? Because I want to live off of the dividend income earlier and not in 50 years. That is why I'm investing heavier in JEPI, in these higher yielders. Okay. Now, if I were to be 20 years old, be in a career that I absolutely loved and love working and being an employee or whatever it may be, and I had 40 years, well, yeah, then I would go heavy into Apple and Costco and Microsoft. But because I have a much shorter time horizon, I want to invest into companies or ETFs that have a higher starting yield. And so this is kind of the brain exercise that you can go through if you're thinking about, okay, well, how much do I need to pay off my utilities? So I never have to worry about my utilities ever again. Well, you can go through the same exercise. Well, what kind of dividend ETFs or companies should I hold in my portfolio? How is this going to help me get to that goal? At the end of the day, everybody, these ETFs, these stocks, they're just vehicles. They're vehicles to help you get to your destination. But in order to get there, you have to kind of have an idea of what your destination is. And so if you're just at random investing into companies because you think they're cool or you like the brand, you're doing it wrong. You have to think about what is your destination and what vehicle do you need? What vehicle is going to get you to your destination? And one last thing that I'll say here, this is probably the most important thing, is when you're thinking about reaching financial independence and retiring early off of dividend investing, you want to project your annual expenses. So whether it be, not just looking at your mortgage, not just looking at your car payment, your utilities, look at your all-in expenses. In 5 years, I project that my all-in expenses will be X, Y, and Z. That's your destination. You know what your annual or your projected annual expenses are. Now, emphasis on projected, because no one has a crystal ball. You have to make your best guess. And that's what it is. It is a guess because you can't predict the future. So you have to project, okay, if my time horizon is 20 years, you might be a little bit looser, right? Well, I'm not quite sure. I don't have kids yet. I don't have a house. I don't know if I like to travel or if I like expensive things, etc. If you have 2 or 3 or 5 years before you plan to retire, well, what are your annual expenses today? Do you expect them to go up or down in 5 years? And then once you have your annual expenses, right, this is what I would recommend you do. Let's say, for example, you have your annual expenses and they're $100,000. Because then what you can do is you can start thinking, okay, well, if I need $100,000, what should my overall portfolio yield be? Right? And that's a mixture of high dividend stocks and ETFs and, growth stocks, dividend stocks and ETFs that have maybe a different variation of their dividend yield. But then you start thinking, okay, well, if I need $100,000, if I only invest into SCHD, then I'm going to need something like, okay, I need $3 million today in my portfolio if I only invest into SCHD. But then if you start thinking to yourself, okay, well, what if I have a combination of SCHD, JEPI, Costco, Coca Cola, maybe some other high yielders, some utility stocks, SIN stocks, etc., that increases your dividend yield to maybe 6%? Well, then you only need just under $1.7 million, right? So this is the math that you want to start thinking about. It's just numbers, right? How do you make the numbers work for you based off of your time horizon, the growth rates, and then you work backwards. But if you do not have the destination, meaning what your annual expenses are, then you're kind of going to be just drifting around and not really making any, you're just going to be kind of floating around and not really end up anywhere. Once you have your destination defined, that's when you really get to work. That's when you really start putting, the thought process into, okay, I know that my annual expenses are $100,000. I know that I'm going to need this money in 5 years. What investments do I pick? Do I pick Costco? Do I pick Apple? Or do I pick SCHD? Or do I pick a dividend stock that's paying a higher dividend? At the end of the day, it all comes down to, what is your average dividend yield? That's all it comes down to, okay? And once you understand that, once you have your destination, you can pick the right vehicle that's going to help you get there. Thanks for watching, everybody. I hope that this video was helpful, and I'll catch everybody in next week's video.
Please subscribe, please subscribe.
Subscribe.
Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.